Have you ever thought about investing in stocks but felt overwhelmed by the process? You're not alone. The world of stocks might seem like a labyrinth for beginners, but fear not, it's simpler than you think. Investing is not just about making money, it's about securing your future and achieving your financial goals. It's about making your hard-earned money work for you. And the good news? You don't need to be a Wall Street wizard to start. By the end of this video, you'll have a clearer understanding of the 10 steps to investing in stocks. The first step to investing in stocks is to assess your financial situation. Picture this, you're planning a trip. You wouldn't set off without knowing how much fuel you have in the tank, would you? The same applies to investing. It's crucial to know how much you can afford to invest, and this doesn't mean draining your savings or maxing out your credit cards. Consider your disposable income. This is the money left over after you've paid your bills, fulfilled your obligations, and catered to your basic needs. This is the fuel for your investment journey. It's the money you can use without impacting your daily life. It's also the money you can afford to lose without affecting your ability to meet your essential costs. As you dip your toes into the investment pool, remember this golden rule. Only invest what you can afford to lose. It's all about balance. You don't want to risk your financial stability for the sake of potential gains. After all, the stock market can be unpredictable. And while there's a chance for high rewards, there's also a risk of losses. So, as you prepare to embark on this journey, take a careful look at your finances and make a realistic assessment of what you can put into the investment pot. Remember, only invest what you can afford to lose. Next, it's crucial to understand your risk tolerance. Risk tolerance is essentially how comfortable you are with the possibility of losing money on your investments. It's about striking a balance between the potential for high returns and the risk of substantial losses. Imagine you're on a roller coaster. How would you react to the ups and downs? Would you enjoy the thrill or would you be scared? Your reaction to these highs and lows is akin to your risk tolerance in investing. Different investment styles require different levels of risk tolerance. For instance, day trading involves buying and selling stocks within a single day, and it can lead to high short-term gains, but also significant losses. On the other hand, a buy and hold strategy involves purchasing stocks and holding onto them for a long period, potentially offering more stability, but possibly with slower growth. Understanding your risk tolerance helps you choose an investment style that suits you. It's about knowing yourself, your financial goals, and how much risk you're willing to take to achieve those goals. Remember, there's no one-size-fits-all approach to investing. Your risk tolerance will guide your investment decisions. The third step is to set clear financial goals. This is a pivotal part of your investing journey. Financial goals are like the destination on your investment roadmap. They give you a sense of direction and purpose. Whether it's saving for retirement, a new home, or your child's college education, having a clear goal can significantly influence your investment strategy. It'll help you decide how much you need to invest, how long you should stay invested, and what kind of returns you should expect. But remember, not all goals are created equal. Some are short-term, like saving for a holiday or paying off a debt, and others are long-term, like planning for your retirement. Short-term goals might require safer, lower-risk investments, while long-term goals could afford to take on a bit more risk in exchange for potentially higher returns. So take some time to think about what you want to achieve. Write your goals down, make them specific, measurable, achievable, relevant, and time-bound. This is what we call setting smart goals. Having clear goals will keep you focused and motivated. Once you've set your goals, the next step is to choose the right type of investment account. Now, there are several types you can choose from, each with its own pros and cons. Let's start with individual retirement accounts, or IRAs. These are ideal for long-term goals like retirement, as they offer tax advantages. Traditional IRAs offer tax deductions on contributions, while Roth IRAs provide tax-free withdrawals in retirement. Next, we have standard brokerage accounts. These are flexible and have no restrictions on when you can withdraw your money, making them perfect for short-term goals. However, they don't offer the same tax benefits as IRAs. Then there are education savings accounts like the 529 plan or Coverdell ESA. These are specifically designed to help save for education expenses and offer tax advantages. Finally, consider looking into health savings accounts or HSAs if you're planning for future healthcare costs. They offer triple tax benefits, tax deductions on contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. So each account type serves a different purpose and offers unique advantages. It's important to align these with your financial goals and risk tolerance. Choose an account that best suits your financial goals and risk tolerance. Now it's time to choose a brokerage firm. Think of a brokerage firm as your gateway to the stock market. They provide you with the platform to buy and sell stocks and offer a range of other services that can help you navigate the investing world. When choosing a brokerage firm, consider the fees they charge. This can include trading commissions, maintenance fees, and service fees. Some firms even offer a subscription-based model, which can be a cost-effective option if you plan on making a lot of trades. It's not just about the fees, though. Customer service is another important factor. You want a firm that's responsive and ready to help when you need it. Look for firms that offer customer service via phone, email, or live chat, and read reviews to see what other customers have to say about their experiences. Also, consider the firm's reputation and how long they've been in business. Established firms are likely to have robust systems in place and a track record of reliability. Remember, the goal is to find a firm that fits your needs and budget. A good brokerage firm can make the investing process much easier. Next, you need to understand the stock market. Picture it as a grand marketplace, a bustling bazaar where buyers and sellers trade shares of companies. You see, when you buy a stock, you're buying a piece of a company, a slice of the pie, if you will. These pieces or shares represent a claim on the company's assets and earnings. Now, how does one buy a stock? Well, it's simple. Stocks are bought and sold through exchanges such as the New York Stock Exchange or the Nasdaq. You place an order through your brokerage account, stating how many shares you want to buy or sell and at what price. The exchange then matches you with a seller or buyer willing to trade at that price. It's a bit like an auction, with the highest bidder taking home the prize. But remember, the stock market isn't just about buying low and selling high. It's a platform for companies to raise capital for growth and for investors to become part owners of these companies, sharing in their success or failure. Understanding the stock market is key to making informed investment decisions. The 8th step is to research potential investments. Knowledge, they say, is power. And in the world of investing, it's your best defense against making poor choices. It's crucial to understand the company you're investing in, its business model, and the industry it operates in. You might ask, where do I find this information? Well, a good place to start is the company's annual report. This document usually contains a wealth of information about the company's financial health, plans, and market position. You can also turn to reputable financial news outlets and analysis websites for insights. Don't forget to look at the company's earnings reports too. These will give you a sense of how the company is performing financially. Earnings per share, revenue, and net income are all important indicators of a company's financial health. In addition, consider the overall economic climate and how it might affect the company's performance. For instance, a company in the tourism industry might struggle during an economic downturn. Remember, the goal of research is not to predict the future, but to gauge the potential risks and rewards of an investment. Never invest in a stock without doing your homework first. Once you've done your research, the next step is to buy and monitor your investments. To buy stocks, you'll use the platform provided by your chosen brokerage firm. This is usually a straightforward process, but if you're unsure, don't hesitate to seek assistance from the firm's customer service. Now, once you've acquired your stocks, your journey as an investor truly begins. Monitoring your investments is just as crucial as making them. This doesn't mean watching the stock market every second of the day, but rather regularly checking in on your investments. This can be done daily, weekly, or monthly, depending on your personal preference and investing strategy. In monitoring your investments, you're looking for changes that might affect your financial goals. This could be a significant jump or drop in a stock's value, or perhaps a change in the company's leadership or business model. By staying informed about your investments, you're better equipped to make decisions such as whether to hold on to a stock, sell it, or buy more. Investing in stocks isn't about making a quick buck. It's a long-term commitment that, when approached with patience and diligence, can lead to substantial financial growth. Remember, investing is not a one-time activity. It requires ongoing attention. And there you have it. The 10 steps to investing in stocks, from assessing your financial situation to understanding your risk tolerance, setting clear financial goals, choosing the right type of investment account, selecting a brokerage firm, understanding the stock market, researching potential investments, and finally, buying and monitoring your investments. Each step is crucial, forming a strong foundation for your investing journey. Does any of these investing steps entice you? Let us know in the comments below. Remember, the journey of 1,000 miles begins with a single step. Start your investing journey today.